forget everything you thought you knew about crypto regulation in the US, honestly.
Huh.
For years, this space felt less like, an emerging financial frontier and more like, well, like a legal Wild West.
That's putting it mildly sometimes. Yeah.
Right. Rules were murky, enforcement actions felt sudden, and frankly, pretty unpredictable.
Absolutely. If you were trying to build a crypto business or even just figure out how to invest within U.S. borders, it often felt like navigating a dense fog. You weren't sure where the solid ground actually was.
Yeah, exactly. But lately, something genuinely significant seems to be happening. We're observing a deliberate, unmistakable shift in Washington, D.C.
Mm-hmm.
It feels like a pivot, a real turn towards clarity, and maybe even, dare I say, a potentially more welcoming stance for digital assets.
I think that's a very apt description of the historical landscape and the shift we're seeing now.
Yeah.
The lack of defined parameters, it created significant hurdles. It forced many businesses into really uncertain positions or even prompted them to look offshore. The environment just wasn't conducive to long-term planning or, real innovation for many players.
And this shift, this move towards clarity, what does it actually mean for you listening? As an investor trying to figure out your portfolio strategy, maybe as a developer building the next big thing, or perhaps you're just curious about how this technology fits into the future of finance.
Exactly.
This deep dive is designed to give you the critical intelligence you need to understand what's really happening on the ground.
Because the regulatory environment isn't just background noise, is it? It fundamentally shapes the opportunities and, crucially, the risks in this space.
Couldn't agree more. And that's our mission today. We've pulled together a pretty comprehensive stack of sources for this deep dive. We're looking at the overall market outlook from financial heavyweights like Fidelity Investments, drilling into the legal nuances with insights from experts like Latham and Watkins and Gordon Law Group, analyzing the roles of key regulators with help from Alpha Point on the SEC and Merkle Science on the CFTC.
Yeah, cover the key players.
And even exploring how institutional players are navigating this new landscape thanks to XBTO. Our goal here is to cut through the noise, extract the most important nuggets of knowledge, maybe reveal some surprising facts, and ultimately give you a clear picture of what to expect from U.S. crypto regulation in 2025 and beyond.
And that covers a lot of ground, what the regulators are actually doing, how the banking system might be opening up.
And yes, what's fundamentally changing with crypto taxes, which, let's be honest, impacts every single person holding digital assets in the U.S.
It's a crucial time for anyone involved in crypto in the U.S., no doubt. Understanding these changes is absolutely paramount.
Okay, let's start with that big picture shift you mentioned earlier. You talked about the historical challenges, the fog. What's fundamentally different now?
Well, as you said, historically, operating crypto platforms, crypto businesses in the U.S. was challenging, primarily because the rulebook was just so vague. Businesses genuinely didn't know if they were dealing with securities, commodities, or maybe something else entirely. Which agency even had jurisdiction? What did compliance actually look like? This uncertainty, it just led to hesitancy and a lot of friction.
Yeah, it felt less like navigating a regulated industry and more like trying to guess what the regulators wanted, often after they had already taken action against someone else.
Precisely. That whole regulation by enforcement label wasn't just cynical commentary, it was often the reality. The industry learned the rules through costly legal battles, not clear upfront guidance. However, the sources we've looked at, they paint a really clear picture of a significant pivot happening. Washington now appears to be moving in a, let's say, more favorable direction for crypto. Fidelity specifically points to recent developments indicating growing momentum towards more positive regulatory environment.
And it's hard to ignore the signals coming from the top, isn't it? We have a new presidential administration that's been, well, remarkably public in its support for the crypto industry. I mean, pledging to make the U.S. the crypto capital of the world, that's a pretty strong statement.
It certainly is. And both Alpha Point and Fidelity identify the supportive political environment as a key catalyst for the changes we're seeing. This public stance, it influences the priorities and the approaches of the regulatory agencies.
So it trickles down.
It signals a desire to move away from that regulation by enforcement model towards something potentially more constructive. And the Latham tracker, which keeps tabs on these regulatory actions, it actually documents several instances of agencies rescinding previous guidance that was seen as restrictive. That further supports this narrative of a shift.
Okay, so it's not just talk. We're seeing tangible actions reflecting this new direction. And it's kind of counterintuitive, isn't it?
Yeah.
Usually industries push back against more regulation.
Right.
But the crypto space has actually been, well, clamoring for it for years.
That's one of the really fascinating aspects here. Unlike many established industries, the loudest voices in crypto have actually been advocating for regulation. But crucially, they want clear, transparent, and tailored regulation.
Not just any rules, but rules that make sense for the technology.
Exactly. The goal, as Alpha Point and Fidelity emphasize, is to create a framework that the industry can actually understand and comply with, something that fosters confidence among all participants, from developers building new protocols to large institutional investors considering allocations.
They want a predictable environment. They want to know the rules of the road before they start driving, not find out by hitting a pothole.
Well put. A transparent framework is seen as absolutely essential for fostering innovation and building trust. Now, Fidelity does inject a note of caution here.
Okay.
While the overall direction looks favorable, the specific details of any potential new legislation or regulatory frameworks, they're still in the early stages, rough drafts, really. And they are certainly subject to change as they navigate the whole political and bureaucratic process.
So optimism, but tempered with realism about the timeline and specifics.
Exactly. The direction seems clear, but the exact path and the final destination still being defined.
Got it. So the overarching theme is this fundamental shift towards clarity, a more supportive stance, maybe driven from the top, moving away from enforcement-heavy tactics. But the specifics are still a work in progress. That sets the stage really well. Now, let's zoom in on the agencies that are really shaping this landscape day to day, the SEC and the CFTC.
Right. These are definitely the two heavyweights in the U.S. crypto regulatory space, and their roles are certainly evolving. Let's start with the SEC, the Securities and Exchange Commission.
Often viewed historically as the crypto nemesis, as Alpha Point actually puts it. That tells you something about the past relationship.
It does indeed. That label really reflects the industry's perception based on the SEC's past approach. Alpha Point highlights that approach as being characterized by, and I quote, legal imprecision and commercial impracticality. Yeah. And Commissioner Hester Pierce herself, who's now playing a key role, has used similar language. She's acknowledged that the previous stance, basically trying to shoehorn novel digital assets into existing securities frameworks designed decades ago for completely different things, well, it created significant compliance headaches and arguably stifled legitimate activity.
And this led to those broad enforcement actions we talked about earlier, right? Targeting firms, exchanges, even individuals sometimes.
Exactly. Alpha Point notes this focus on broad enforcement under the previous leadership. However, with the change in administration and leadership at the agency, the strategy appears to be shifting. The Latham tracker points to actions like the dismissal of the SEC's enforcement case against Coinbase back in February 2025.
That was a big one.
As a tangible sign of this pivot away from that previous, let's call it, enforcement-heavy posture towards regulated entities.
So less about casting a wide net of enforcement and maybe more about what?
Right.
Trying to actually build that clear framework everyone's been asking for.
Precisely. And a major manifestation of this new focus is the launch of the SEC Crypto Task Force in January 2025. Alpha Point identifies this task force, led by Commissioner Hester Pierce, as a really pivotal initiative.
Crypto mom herself, who's consistently advocated for clearer rules from within the SEC for years.
Yes, she has. And the task force's explicit goal is to create a comprehensive, transparent framework. They're working specifically to untangle what Pierce herself has called the regulatory mess.
Okay.
Their priorities are squarely focused on the fundamental questions the industry needs answers to. Things like clarifying the security status of digital assets, perhaps the single biggest question mark.
The $1 million or maybe $1 billion question.
Right. Defining the boundaries of SEC jurisdiction, addressing registration challenges for platforms and intermediaries, and finding a workable path for traditional broker-dealers to actually custody digital assets securely and compliantly. These are the bedrock issues that need resolution for the industry to mature within the U.S.
And Alpha Point notes they are welcoming input from the industry, from the public. That feels like a significant change in tone compared to the past.
It does. And it's likely intended to signal a desire to build a framework that is not only legally sound, but also practical and effective for the technology and the market participants. It suggests a more collaborative approach might be on the table.
Okay, let's get specific then. What concrete actions have we seen from the SEC staff or commissioners in 2025 that reflect this new direction? Actions that pull back old restrictions or offer some new clarity?
The Latham Tracker and Alpha Point highlight several key actions, and a significant theme is definitely the withdrawal of previous guidance that was seen as restrictive or maybe just unclear. For instance, on May 15, 2025, previous guidance regarding broker-dealer custody of digital asset securities was withdrawn.
Okay.
This prior stance, known as SAB 121, had made it exceedingly difficult, almost impossible really, for traditional brokerages to hold crypto on behalf of clients due to balance sheet implications. So withdrawing that is a big deal for institutional access.
And there was action regarding those expanded dealer rules, too. Those caused quite a stir when they came out.
They did. Huge controversy. These rules, finalized in early 2024, were criticized for potentially capturing a really wide range of market participants, including potentially many in DeFi, under the definition of a securities dealer, which would require incredibly onerous registration.
Yeah.
The SEC voluntarily dismissed its appeal related to challenges against these rules on February 20th, 2025. That effectively steps back from that controversial expansion, at least for now.
And as you mentioned earlier, the dismissal of the Coinbase case on February 27th, that must have sent a major signal to the market.
Absolutely. While the specific legal reasons are complex, dismissing such a high-profile enforcement action against a major publicly traded regulated exchange, well, it's widely interpreted as indicative of a less aggressive, maybe more deliberate approach from the SEC, as noted by both Alpha Point and the Latham Tracker.
Okay, so beyond pulling back old rules, has the SEC staff started providing clarity on the flip side? On what isn't considered a security? Because that is it a security question has been the source of so much confusion and anxiety.
This is a key area where the influence of the new task force seems to be becoming apparent, even if the formal framework is still under development. The SEC staff has begun issuing specific statements providing much-needed clarity on certain types of assets or activities that, under specific conditions, they do not view as involving securities.
Oh, interesting. Like what?
The Latham Tracker lists several important examples from early 2025. On February 27th, there was a statement clarifying that certain meme coins, if they meet very defined characteristics centered around being purely speculative, with no expectation of profit derived from the efforts of a specific promoter or group, are not considered securities.
Okay, so defining a narrow carve-out there.
Exactly. Then, on March 20th, clarification came stating that proof-of-work mining activities, like those used for Bitcoin, do not in themselves involve the offer or sale of securities. That's important for miners and mining pool operators.
Definitely.
A very significant one came on April 4th regarding dollar-backed stablecoins. The staff stated that certain stablecoins specifically defined as covered stablecoins, which maintain a strict 1.1 peg to USD, are fully redeemable 1.1 for USD, and crucially, are fully backed by low-risk, highly liquid reserves equal to or exceeding the value in circulation, do not fall under securities laws.
Wow. That provides a much clearer path for a specific compliant type of stablecoin, which is critical market infrastructure.
Absolutely. And most recently, on May 29th, the staff clarified that certain protocol staking activities, specifically including self-staking, self-custodial staking, and some custodial arrangements where the staker clearly maintains control over their keys, or the staking is just a simple network validation function, do not constitute the offer or sale of securities under the Howey test.
Wow, those are incredibly specific examples. That level of detail, that nuance, is exactly what people have been asking for years. It shows they're really trying to grapple with the tech.
It is. It feels like a move away from those vague, sweeping pronouncements towards actually trying to draw clearer lines based on the specifics of the technology and the economic reality of the activity. The staff also issued observations on crypto issuer disclosures back on April 10th, emphasizing that disclosures should be tailored to the specific facts and circumstances of the issuer and the asset, rather than trying to apply some rigid one-size-fits-all template.
What about bringing tokenized securities into the traditional system, using blockchain for regular stocks or bonds? Is the SEC exploring ways to make that easier?
Yes, that's another area of focus. Commissioner Pierce indicated in a May 8th, 2025 speech that the Crypto Task Force is actively considering a potential exemptive order. This would essentially provide regulatory relief for firms that want to use distributed ledger technology, blockchain, to issue, trade, and settle traditional securities in a tokenized form. The aim is to make it easier for traditional finance to leverage this technology for existing assets, addressing some of the compliance hurdles they face under current rules that weren't designed for DLT.
That could be huge for efficiency in traditional markets, too. And finally, within the SEC itself, what about their enforcement structure? Has that changed?
There's been a reorganization there as well. On February 20th, 2025, they announced the establishment of the Cyber and Emerging Technologies Unit, or CETU. This unit replaces the previous crypto assets and cyber unit.
Okay, a new name, but what's different?
Notably, it's described as a smaller unit, consisting of around 30 specialists compared to the previous structure's 50 or so. And its mandate is explicitly focused on investigating fraud in emerging technology areas, including AI, blockchain, and crypto assets.
Ah, so narrowing the focus to actual fraud rather than maybe broader compliance sweeps.
That seems to be the implication, yes. It reinforces this idea that enforcement might be getting refocused on clear, illicit activity rather than potentially catching compliant actors in a wide net due to unclear rules.
Okay, so the SEC story is one of shifting from maybe being the nemesis to potentially a more measured regulator, aiming for clearer guidance, targeting fraud specifically. And then there's the huge development that grabbed headlines globally, the approval of crypto ETFs.
This has arguably been one of the most tangible and significant shifts we've seen. Despite years of skepticism and numerous rejections, the SEC made pivotal decisions. Alpha Point and the Latham Tracker confirmed the approval of those 11-spot Bitcoin ETFs back in January 2024.
Yeah, that was a definite game changer for bringing crypto exposure into traditional brokerage accounts easily.
Absolutely. And they followed that up, maybe somewhat surprisingly to some, with the approval of 8-spot Ethereum ETFs in May 2025.
Right.
Alpha Point notes that this momentum is widely expected to continue. There are applications already pending for ETFs covering other major assets like XRP, Solana, SOL, Dogecoin, DOGE, Litecoin, LTC, Hedera, HBAR, and Polkadot, DOT. And experts are predicting a pretty high likelihood of approval for many of these in the near future.
So we could potentially see a much wider suite of crypto investment products available right alongside stocks and bonds on traditional exchanges.
That's certainly the expectation in the market now. This brings these assets into a familiar wrapper, the ETF structure for traditional investors. It aligns them with an existing, well-understood regulatory frameworks like the Investment Company Act of 1940.
Makes it much easier to allocate.
Exactly. Alpha Point highlights that this dramatically increases exposure for traditional traders and facilitates wider adoption by making it much easier for mainstream investors to get involved without needing to directly hold the underlying asset, deal with wallets, keys, etc.
It removes a significant layer of technical complexity and perceived risk for many people just looking for investment exposure. Okay, that's a deep dive into the SEC side. Now, let's talk about the other big regulator here, the CFTC, the Commodity Futures Trading Commission. Where do they fit into this evolving picture?
Right. The CFTC's domain is distinct from the SEC's, though there are overlaps and sometimes confusion. Merkle Science explains that the CFTC primarily oversees commodity futures and options markets.
Okay, commodities, not securities.
Correct. Their jurisdiction over digital assets primarily covers those classified as commodities. Now, currently, the most prominent digital assets generally viewed as commodities are Bitcoin and Ethereum. The CFTC's authority extends to the derivatives based on these commodities, think futures contracts, options, swaps, and the platforms where these derivatives trade, including the clearinghouses that guarantee the trades.
So they regulate Bitcoin futures, for example, but not necessarily buying Bitcoin itself on Coinbase.
Generally, yes. While they don't directly regulate the spot market where you buy BTC or ETH itself, their authority over the linked derivatives gives them significant reach and influence over the ecosystem.
Got it. SEC for securities, CFTC for commodities, and their derivatives. But classifying some assets, especially newer ones, that still seems like a murky area, doesn't it?
It absolutely is. And that's where efforts like the CFTC's Global Markets Advisory Committees, GMXE Digital Asset Market Structure, or DAMS framework from 2024 come in. This is discussed by both Merkle Science and the Latham Tracker. This framework was an attempt by an advisory committee to propose a structure for classifying digital assets within the existing commodity and derivatives rule sets.
Okay, how did the DAMS framework try to categorize things? Did it offer clarity?
Merkle Science outlines the proposed categories they suggested. Platform crypto assets, things like Bitcoin and Ether, clearly seen as commodities under CFTC purview. Then functional digital assets. This would include many utility or governance tokens, often associated with DeFi protocols, and the committee explicitly noted these need clearer guidance. And finally, tokenized alternative assets, basically real-world assets represented on a blockchain.
So it was a proposal, a starting point.
Yes, the GMAC recommended it as an initial basis for developing a consensus-driven taxonomy, aiming to bring some order to that crucial classification debate. It wasn't a final rule, but an important step in the conversation.
Has the CFTC also been active with enforcement actions similar to the SEC's past?
Yes, particularly when it comes to policing compliance within the derivatives markets offered to U.S. persons. Merkle Science highlights that the CFTC has been quite proactive here. They brought some very significant cases over the years.
Can you give us a couple of examples that really show their focus?
Certainly. Merkle Science points to cases like BitMEX back in 2020. They were charged with operating an unregistered platform offering crypto futures and options to U.S. customers, and also failing on critical Know Your Customer, KYC, and anti-money laundering AML requirements. That resulted in a $100 million settlement.
Okay, unregistered derivatives and AML failures.
Exactly. And there was a Binance case in 2024. This is a landmark action. Binance was fined a staggering $3.4 billion by the CFTC, which is the largest crypto-related fine they've ever issued. The charges are similar, offering unregistered crypto derivatives to U.S. customers and significant failures in their AML programs. This case really underscores the CFTC's focus on ensuring platforms serving U.S. customers, especially with derivatives, are properly registered and have robust compliance.
Wow, $3.4 billion sends a message.
It certainly does. And another example, Tether in 2021. They were fined $41 million for making false or misleading claims about the reserves backing their stablecoin. Now, while the stablecoin itself wasn't a derivative, its perceived stability was absolutely crucial for traders using it to margin and settle crypto derivatives contracts. So it highlights the CFTC's interest in anything that significantly impacts the integrity of their core derivatives markets.
So the CFTC has definitely flexed its muscles, particularly around unregistered derivatives platforms and AML compliance for U.S. users. What are the ongoing challenges or developments for the CFTC now?
Merkle Science mentions legislative proposals from 2024 that aim to explicitly expand the CFTC's oversight, potentially even over the crypto spot market for commodities like Bitcoin, to close perceived regulatory gaps between them and the SEC. That's still being debated.
Right, the jurisdiction question.
Exactly. There's also increased international cooperation. They're working more closely with global regulators like the UK's FCA and Europe's ESMA, recognizing that crypto markets are inherently global and cross-border challenges need coordinated approaches. And tying back to our earlier discussion, the growing institutional interest is creating real demand for clearer CFTC guidelines on regulated crypto futures and options products.
Okay. And what about the cutting edge of DeFi, specifically things like decentralized perpetual futures? They seem kind of stuck in a regulatory no man's land.
They certainly seem to be. Paradigm, a venture capital firm focused on crypto, highlights this issue quite clearly. They point out that decentralized perpetuals, these innovative, always-on leverage trading products built on blockchains, are effectively inaccessible or operating in a deep regulatory gray zone for U.S. users right now. Paradigm argues that trying to force these inherently decentralized protocols into regulatory molds designed decades ago for centralized entities like traditional swap execution facilities, SCFs, or designated contract markets, DCMs, simply doesn't work. It's trying to fit a square peg in a round hole, and it stifles innovation.
So the existing regulatory boxes just don't fit the technology.
That's Paradigm's core argument. They believe a fundamentally new approach is needed for regulating decentralized financial infrastructure. To address this specific issue with perpetuals, they've actually proposed that the CFTC establish a Perpetual Special Advisory Committee, or PSAC.
A specific committee just to figure out DeFi perpetuals.
Yes, composed of diverse experts, technologists, legal scholars, market participants, public interest advocates. Paradigm envisions this committee exploring what they call a modernized, tech-neutral regulatory regime, specifically for DeFi derivatives.
What would that involve?
They suggest looking at things like potential public interest exemptions for truly decentralized protocols from some of the traditional registration requirements that don't make sense for them. Developing a fit-for-purpose compliance framework that acknowledges the different roles in a decentralized stack, the core protocol developers versus front-end providers versus individual users. And importantly, finding a clear path for retail users to participate with appropriate disclosures and safeguards, but without creating unnecessary gatekeeping or overly paternalistic restrictions that block access entirely.
That sounds like a direct challenge to the current regulatory inertia around DeFi derivatives. It's pushing for a framework that actually understands and accommodates decentralization rather than just trying to ban it or ignore it.
It absolutely is. It reflects a proactive attempt from within the industry to propose a concrete path forward for a specific area of innovation that is currently largely blocked or operating in the shadows in the U.S. It suggests that a collaborative, tailored approach is necessary, rather than simply applying old rules that don't fit the new technology.
Okay, so we've detailed the evolving actions of the SEC and the CFTC, the complexities around classification, and the challenges with DeFi. Now, let's pivot to traditional finance. For years, banks seemed incredibly hesitant to touch crypto, often citing regulatory uncertainty as the main reason. Is that changing too?
Yes, this is another area where we're seeing significant movement in 2025, and it's largely driven by the rescission, or pulling back, of specific guidance from previous administrations that had effectively constrained bank involvement with crypto. The Latham Tracker details key actions here from the three main federal bank regulators: the Federal Reserve, FRB, the Office of the Comptroller of the Currency, OCC, and the Federal Deposit Insurance Corporation, FDIC.
Okay, let's break those down. Start with the Federal Reserve, the Fed.
Right. On April 24, 2025, the Federal Reserve officially rescinded a 2022 guidance document known as SR Letter 22-6. They also withdrew from joint statements that they had issued with the FDIC and OCC back in 2023 concerning crypto-related activities and risks.
What did that old guidance do?
Previously, that guidance had imposed certain limitations on state-chartered banks that are members of the Federal Reserve System. And importantly, it often required these banks to notify the Fed, or in some cases even obtain supervisory non-objection, basically, get a green light before engaging in what were termed novel activities, which very often include crypto services.
So banks essentially had to ask for explicit permission before dipping their toes into crypto. That sounds like a hurdle.
It was perceived as a significant hurdle, yes. It created an extra layer of friction and uncertainty. By rescinding this, the Fed stated it would now monitor banks' crypto activities through their normal, ongoing supervisory process. This stated goal is to ensure their expectations align with evolving risks, but also, importantly, to support responsible innovation within the banking system. It's a shift away from that pre-approval requirement towards ongoing oversight for permissible activities.
That's a notable shift in approach from the Fed regarding financial innovation. What about the OCC? They regulate the national banks, the big ones.
The OCC took a very clear step as well. On March 7, 2025, they rescinded something called Interpretive Letter 1179. This was a key letter from late 2021 under the previous administration.
And what did IL 1179 do?
It had required national banks to demonstrate they had robust controls in place and obtain supervisory non-objection before engaging in crypto activities that the OCC itself had previously stated were permissible for national banks. Things like providing crypto custody services, holding reserves for certain stablecoins, or participating in blockchain networks as a node operator.
So IL 1179 essentially added a significant barrier or supervisory friction on top of activities the OCC had already said were okay in principle.
Exactly. It walked back the practical ease of engaging in those previously permitted activities. By rescinding IL 1179, the OCC is clearly reaffirming the permissibility of the activities outlined in those earlier letters, specifically ILs 1170, 1172, and 1174, and removing that specific requirement for getting supervisory non-objection beforehand.
So making it practically easier for national banks to offer those services.
Yes. And to underscore this point, in a new interpretive letter, number 1184, issued on May 7, 2025, the OCC further affirmed that national banks can indeed provide crypto custody and execution services. They even detailed the potential range of services, including fiduciary and non-fiduciary custody, buying and selling crypto for customers, facilitating access to crypto exchanges, and providing other related support services. This is very explicit support from the OCC for banks engaging in these crypto services.
That sounds like a pretty clear green light from the OCC for national banks. What about the third major player, the FDIC, which ensures deposits and supervises many state banks?
The FDIC also removed a similar hurdle. On March 28, 2025, they issued a financial institution letter, FIL 7-2025, which rescinded their previous guidance on this topic, FIL 16-2022. That prior guidance had required FDIC-supervised institutions to provide prior notification to the FDIC before engaging in or planning to engage in crypto-related activities.
So another agency dropping the requirement for banks to give them a heads up or ask for permission beforehand.
Precisely. The new guidance clarifies that engaging in permissible crypto-related activities does not require prior FDIC approval or notification. Again, the focus shifts to managing these activities through their standard ongoing supervisory oversight based on risk.
Okay, the combined effect of these actions from the Fed, the OCC, and the FDIC, it seems pretty significant. They appear to be collectively removing regulatory constraints that definitely made banks extremely cautious, maybe even scared, to get involved with crypto.
I think that's a fair assessment. Collectively, these steps remove key regulatory roadblocks that effectively discouraged, or in some cases prevented, traditional financial institutions from seriously engaging with digital assets. They signal a coordinated move by the bank regulators towards a more open, albeit still closely supervised environment for banks interacting with crypto. This shift from requiring upfront permission for specific activities to managing them through standard supervisory processes could indeed pave the way for much greater integration of crypto into traditional banking services. That's been a major missing piece for wider adoption and institutional comfort.
Okay, so the core financial regulators, SEC, CFTC, and the banking watchdogs Fed, OCC, FDIC, are all making significant moves. What about the wider regulatory ecosystem? Agencies like FinCEN, focused on financial crime, or the CFPB for consumer protection, FINRA for brokers, even the accounting standard setters like FASB. How do they fit into this evolving picture?
Right. This is where other important pieces of the regulatory puzzle come into play. These agencies affect critical aspects like anti-money laundering compliance, consumer safeguards, broker conduct, and just how crypto actually shows up on company balance sheets.
Let's start with FinCEN, the Financial Crimes Enforcement Network. Their focus is on preventing money laundering and terrorist financing, which has been a recurring theme and often a criticism in crypto discussions.
Yes, and they've remained active in proposing rules specifically for the crypto space. The Latham Tracker notes a significant proposed rule from October 2023. This proposal would designate non-U.S. crypto mixing services as a primary money laundering concern under Section 311 of the USA Patriot Act.
What does that designation mean practically?
That Section 311 designation is a powerful tool, usually applied to foreign jurisdictions or financial institutions deemed high risk. Applying it to a type of transaction like international mixing is quite notable. If finalized, it would impose enhanced due diligence and reporting requirements on U.S. financial institutions that deal with transactions involving these international mixers, aiming to restrict illicit finance flows.
They also had a proposal floating around about unhosted wallets, right? Requiring tracking for certain transactions.
Yes, that's another important one. A proposal that actually originated back in the late Trump administration, but is still under consideration, would require banks and money service businesses, think exchanges, to report, record, and verify identity for certain transactions involving unhosted wallets, meaning wallets where the user controls the private keys, or wallets hosted in certain foreign jurisdictions.
How would that work?
The proposal aims to treat convertible virtual currency, CVC, and legal tender digital assets, LTDA, as monetary instruments under the Bank Secrecy Act, BSA. This would bring them under existing currency transaction reporting rules, like the $10,000 threshold, and add new record-keeping requirements for smaller transactions, effectively extending traditional AML-CFT frameworks to cover movements in and out of non-custodial and certain foreign crypto holdings.
That sounds like it could have significant implications for self-custody and DeFi interactions.
Potentially, yes. It's a complex and controversial proposal. Interestingly, though, on a somewhat different note, we saw the Treasury Department remove the economic sanctions against Tornado Cash, the crypto mixer, earlier this year, in March 2025, according to the Latham Tracker.
Right. The previous administration had sanctioned the code itself. Removing that seems like a different signal compared to the FinCEN proposals focusing on mixers.
It could be seen as a different signal, perhaps distinguishing between the technology itself and its specific malicious use. However, FinCEN's proposed rules clearly show that regulatory scrutiny of mixing services from an anti-money laundering perspective remains very high, even if direct OFAC sanctions on the protocol were lifted.
Okay, so AML remains a major focus. Shifting gears to consumer protection, what about the CFPB, the Consumer Financial Protection Bureau?
The CFPB had made some moves under the previous administration. They proposed regulating large digital wallets and payment apps back in November 2023, aiming to apply the same kind of supervisory rules that banks face to large non-bank fintech providers.
Did that proposal move forward under the new administration?
No, it did not. The Latham Tracker specifically notes that this proposal was actually rescinded on May 9, 2025. It was overturned using the Congressional Review Act, CRA, a mechanism Congress can use to nullify recent agency rules, and signed by President Trump.
So a clear instance of the new administration actively rolling back a regulatory effort from the previous one in the fintech space.
Exactly. It was seen by some as potentially overreaching into non-bank fintech, and the CRA was used to eliminate it.
And the CFPB also had another proposal, something about extending consumer protections to stable coins and maybe gaming accounts.
Yes. Just before the change in administration, in January 2025, the CFPB issued a proposed interpretive rule. This sought to extend protections under the Electronic Funds Transfer Act, EFTA, think rules around error resolution, liability for unauthorized transfers to cover certain stablecoin wallets, some digital assets used in online gaming, and potentially even some credit card rewards programs.
What's the status of that one?
As the Latham Tracker points out, given the subsequent CRA rescission of the broader digital wallet rule and the general deregulatory stance observed from the new administration, this ESTA proposal is considered pretty unlikely to gain significant traction in its current form. It's flagged as an area where agency interests intersect, but its future seems uncertain at best right now.
Okay, what about FINRA? They're the self-regulatory body for broker-dealers in the U.S.
FINRA published an exploratory report on the metaverse back in October 2024. Now, this report didn't create any new rules,
Right.
but it served as an important reminder. Existing FINRA rules and federal securities laws do apply to brokerage activities, regardless of the technology used. So if a broker-dealer is offering securities brokerage services within a metaverse platform or using similar emerging technologies, the same compliance obligations apply as if they were doing it via a traditional website or phone call. Technology doesn't change the underlying regulatory requirements for regulated activities.
Makes sense. And finally, accounting standards. This might seem dry, but it's actually huge for companies holding crypto. How is crypto being treated on balance sheets now?
This is a really important change for transparency. The Financial Accounting Standards Board, or FASB, approved an update on September 6, 2023, that standardizes how companies account for crypto assets under U.S. generally accepted accounting principles.
That was the old way.
Previously, there wasn't a specific standard. Crypto was often accounted for using rules for intangible assets, which meant it was typically held at its historical cost, minus any impairment losses. Increases in value were generally not recognized until the asset was actually sold.
So a company like MicroStrategy, holding billions in Bitcoin, their balance sheet wouldn't necessarily show the current market value of those holdings. That seems unhelpful for investors.
Exactly. FASB deemed that approach insufficient for providing decision-useful information to investors and other stakeholders. The new standard requires entities holding crypto assets that meet certain criteria to measure those assets at their fair value each reporting period.
Meaning current market value.
Yes, based on observable market prices where available. And crucially, any changes in that fair value, whether gains or losses, must be recognized in the company's net income for that period. It also mandates enhanced disclosure requirements about the nature of the holdings, restrictions, and valuation methods.
So much greater transparency about the current value and volatility of corporate crypto holdings.
Precisely. It brings crypto accounting more in line with how other financial assets are treated and makes it much clearer for investors to understand the actual economic impact of crypto holdings on a company's financial position and performance.
Okay, that covers a wide range of other agencies, all touching crypto in different ways. But let's be honest, for many individuals, the most immediate and sometimes the most painful interaction with regulation comes through taxes. What's the outlook for crypto taxes in 2025? This seems like a huge area of change.
It's absolutely critical, yes. And the source we reviewed from Gordon Law Group provides a very detailed and frankly pretty eye-opening look at the major changes coming. The fundamental principle isn't changing. The IRS treats crypto assets as property, not as currency.
Right, property, meaning capital gains rules apply.
Exactly. And because it's property, almost every transaction involving your crypto is a potentially taxable event.
So it's not just selling for US dollars that triggers tax. I think a lot of people still get confused there.
No, absolutely not. That's a common and dangerous misconception. It includes swapping one cryptocurrency for another, say, trading Bitcoin for Ethereum, or even trading Ether for a stablecoin like USDC.
Even swapping to a stablecoin.
Yes. The IRS views that as selling the first crypto for its fair market value at the moment of the swap, and then immediately using those proceeds to buy the second crypto. That first sale is a taxable event where you realize a gain or loss. Other triggers include using crypto to buy goods or services, buying a pizza, a car, whatever, or trading crypto for an NFT. Each of these is treated as a disposition of property, potentially triggering capital gains tax.
Okay, that's the baseline. But you said significant changes are coming starting January 1st, 2025. What are they?
The biggest, most impactful change is the introduction of Form 1099-DA. Starting January 1st, 2025, all U.S. crypto exchanges and certain other entities defined as brokers under the new rules must track your transaction activity throughout the year.
Track everything.
Track proceeds from sales and potentially other transaction details. And crucially, they must report this information directly to the IRS on this new Form 1099-DA. You, the user, will receive a copy of this form in early 2026, detailing your 2025 activity that the platform reported.
Whoa. Okay. So similar to how stockbrokers send out 1099-Bs for stock trades, the IRS will now automatically receive detailed reports of my crypto sales and potentially other transactions directly from the exchanges I use.
Precisely. Gordon Law Group stresses that this makes it exponentially easier for the IRS to identify taxpayers who are not reporting their crypto transactions accurately or at all. The ability for significant activity on regulated U.S. platforms to go unnoticed by the IRS is effectively ending for the 2025 tax year and going forward.
That is a massive shift for individual tax compliance and enforcement. Wow.
It is. And there's another related change impacting how you calculate gains and losses. Beginning January 1st, 2025, the rules shift towards requiring wallet-by-wallet or account-by-account cost-basis accounting, rather than allowing a universal accounting method across all your holdings.
What does that mean practically?
It means you need to track the cost basis of your crypto based on which specific wallet or exchange account it's held in when you sell it. This can add significant layers of complexity if you move assets frequently between different platforms or self-custody wallets, unless you have very sophisticated tracking tools or software that can handle this correctly.
Okay, speaking of moving assets, transferring crypto between my own wallets, say from my exchange account to my hardware wallet, that's not taxable, right? But I still need to track it.
Critically important point.
Yeah.
Yes, transferring crypto between wallets or exchanges that you personally control is not a taxable event in itself. However, Gordon Law Group emphasizes that you absolutely must meticulously track these self-transfers.
Why, if it's not taxed?
Because you need that information to maintain the accurate cost basis trail for that crypto. If you buy Bitcoin on exchange A, transfer it to wallet B, then later sell it from wallet B, you need records showing the original purchase price from exchange A to calculate your gain or loss correctly when you sell from wallet B. If you don't track the transfer, your cost basis information gets lost, which is a major compliance issue. This is very different from traditional stocks, where brokers handle cost basis tracking for you during transfers between brokerage accounts. With crypto, the onus is entirely on you for self-transfers.
Got it. Track those self-transfers religiously. Now, with the IRS getting all this new 1099-DA data directly from exchanges, are they expected to ramp up enforcement and audits?
Absolutely. Gordon Law Group explicitly states that the IRS has already been increasing its focus on crypto compliance in recent years, and they are expected to significantly increase audits now that they will have this comprehensive data feed via the 1099-DA forms.
Makes sense. They'll have the data to cross-reference.
Exactly. The advice is clear. If you have any unfiled or inaccurate crypto tax reporting from previous years, now is definitely the time to get compliant and amend those returns, because the IRS will soon have much better tools to automatically spot discrepancies going forward.
Okay, let's make it crystal clear for everyone listening. Can you quickly recap the common transactions that trigger capital gains tax?
Sure, capital gains tax applies when you dispose of crypto that you acquired, and it has appreciated in value since you acquired it. Gordon Law Group lists the most common triggers: selling crypto for US dollars or other fiat currency, cashing out; converting or swapping one crypto for another, e.g. BTC for ETH, ETH for USDC. Remember, that's treated as selling the first one. Using crypto to pay for goods or services, trading crypto for an NFT, or trading an NFT for crypto. For each of these events, you need to calculate the gain or loss. It's the sale of proceeds, the fair market value when you disposed of it, minus your cost basis, which you originally paid for it, plus any fees.
And the tax rate depends on how long you held it.
Correct. Short-term capital gains, if you held the asset for 1 year or less, are taxed at your ordinary income tax rate, which can range from 10% up to 37%. Long-term capital gains, if you held for more than 1 year, qualify for lower preferential rates, 0%, 15%, or 20%, depending on your overall taxable income. And you need to calculate this gain or loss for every single taxable disposition.
Okay, that's capital gains, selling, trading, spending. What about ordinary income? When does that apply to crypto?
Ordinary income tax applies when you receive crypto in ways other than buying it with your own fiat money. The amount you report as income is the fair market value in US dollars at the exact moment you received the crypto. Gordon Law Group gives common examples like receiving rewards from crypto mining, receiving rewards from staking activities, receiving crypto from an airdrop, getting paid in crypto for your services as salary or bonus, or for selling goods or NFTs if that's your business, earning interest, yield, or other rewards from lending crypto or participating in DeFi protocols.
So income when you receive it, and then what happens when you later sell that crypto you received as income?
That's a crucial second step. The fair market value you reported as ordinary income also becomes your cost basis for that specific crypto you received. So if you later sell, trade, or spend that crypto, it becomes a separate capital gains event. You then calculate the capital gain or loss based on the difference between the selling price and that cost basis, the value when you received it.
Okay, that distinction is really important. Receiving crypto can be income, and then disposing of that same crypto later triggers a capital gains event. Two separate taxable moments, potentially.
Exactly. And it's a key reason why meticulous, time-stamped record keeping is absolutely essential.
Yeah.
You need to know when you received it, its value then for income, and then track it until you dispose of it for capital gains.
Phew. Okay. Are there any crypto transactions that are generally not taxable, things you don't have to worry about reporting as income or gain?
Yes, there are a few important ones, although, as we discussed, tracking is still usually required for cost basis purposes. Gordon Law Group lists these. Purchasing crypto with US dollars or other fiat currency. That's just acquiring property. No gain or loss is realized then. Transferring crypto between your own wallets or exchange accounts. Again, not taxable itself, but vital to track for cost basis. Simply holding crypto, even if its value goes way up. These are unrealized gains, and they're generally not taxed unless you sell or dispose of the asset, or unless you qualify for very specific trader tax status, which is rare. Giving crypto is a bona fide gift. Generally, this isn't income for the recipient, and the giver doesn't realize gain. However, if the gift is large, the giver might need to file a gift tax return, but tax is usually only paid above very high lifetime exclusion limits. The recipient inherits the giver's cost basis. Donating crypto directly to a qualified nonprofit organization, a 501c3. This can be a very tax-advantaged strategy. You generally avoid paying capital gains tax on the appreciation, and you might be able to take a charitable deduction for the fair market value at the time of donation.
Okay, so buying with fiat, holding, transferring your own assets, gifting within limits, and donating to charity are generally non-taxable events. Good to know. What about losses? If my crypto investments go down in value and I sell, do I need to report that? Or can I just ignore it?
Oh, you absolutely need to report losses, and you want to report them. Gordon Law Group makes this very clear. Reporting your crypto capital losses is crucial because they can be used to offset your capital gains from crypto or other investments.
So losses reduce gain.
Exactly, dollar for dollar. And if your losses exceed your gains in a given year, you can use up to $3,000 of the excess loss to offset your ordinary income, like salary. Any remaining loss beyond that can be carried forward to future tax years to offset future gains. So accurately reporting losses is key to reducing your overall tax liability. You must report both gains and losses.
Got it. Don't ignore the losses. And what are the potential downsides if someone doesn't report their crypto activity accurately, especially now with the 1099 DA coming online for 2025?
The consequences can be quite severe. We're talking about IRS audits, which can be time-consuming and stressful. Significant financial penalties, often calculated based on the amount of unpaid tax and accuracy-related issues. Substantial interest charges accumulating on the unpaid taxes. And in serious cases of intentional evasion, it could even lead to criminal tax investigations and prosecution. Gordon Law Group warns that the IRS is deploying increasingly sophisticated tools and data analysis to identify non-compliance, and the 1099 DA data stream will significantly enhance their ability to do this automatically. Trying to fly under the radar is becoming an extremely risky strategy.
Okay, message received. So for someone listening who wants to get this right for their 2025 taxes, which they'll file in 2026, what's the basic process they need to follow?
Gordon Law Group outlines the essential steps. 1. Gather everything. You need to compile all your transaction history. That means reports from every exchange you use, transaction logs from any self-custody wallets, records from DeFi platforms, NFT marketplaces, everything. They note that the summary forms exchanges currently provide are often insufficient on their own for accurate calculation. You need the detailed transaction data. 2. Calculate everything. This is often the hardest part. You need to meticulously calculate the cost basis and then the resulting gain or loss for every single taxable event that occurred during 2025, every sale, swap, trade, spending event. You also need to track the value of any crypto received as income. This detailed calculation data goes on to IRS Form 8949, Sales and Other Dispositions of Capital Assets. 3. Summarize. The totals calculated on Form 894014, total short-term gains losses, total long-term gains losses, are then transferred to Schedule D of your main Form 1040 tax return. Schedule D is where all capital gains and losses are ultimately reported. 4. Report income.
Any crypto you received as ordinary income, from mining, staking, airdrops, payments, etc., needs to be reported separately on your tax return. Where exactly depends on the nature of the income, often on Schedule C, if it's related to a business or self-employment activity, or potentially on other lines of Form 1040. 5. Consider professional help. Gordon Law Group strongly advises seeking advice from a qualified tax professional who specifically specializes in cryptocurrency taxation. This is especially true if you have complex transactions, DeFi, NFTs, margin trading, etc., high-volume trading, or if you need help correcting reporting errors from previous years. They also caution that while crypto tax software can help automate the calculations, these tools can sometimes struggle with accurately handling complex DeFi interactions, valuing NFTs correctly, dealing with less common blockchains, or properly distinguishing between taxable swaps and non-taxable transfers. Software can sometimes mislabel transactions or even inflate income if not configured and reviewed carefully. Professional review is often necessary for accuracy and peace of mind.
Wow. That tax section alone is a huge, incredibly actionable takeaway for anyone holding crypto in the US. Get organized now for 2025. Understand what triggers tax, track everything meticulously, especially those self-transfers, and be prepared for the IRS to have much more direct data than ever before, starting with the 2025 tax year. And seriously consider getting professional help if you're unsure.
Absolutely. The implementation of Form 1099-DA for 2025 activity reported in 2026 is poised to fundamentally change the tax compliance landscape for anyone using US-based crypto platforms. Ignorance will no longer be a viable excuse if it ever was.
Okay, so with all this regulatory movement happening, clearer rules from the SEC, banks getting cautious green lights, and this major overhaul in tax reporting, how is this impacting the broader market, particularly institutional investors? Are they finally getting comfortable enough to jump in with serious capital?
This is really where the rubber meets the road, isn't it? And according to the analysis from XBTO, a firm specializing in institutional crypto, improving regulatory clarity is a key factor, perhaps the key factor that is unlocking significant institutional participation.
Because for years, that uncertainty was the big wall.
It was a major barrier, yes. Large funds, corporations, traditional asset managers. They operate under strict fiduciary duties and compliance frameworks. They need a clear rulebook and a predictable environment before they can deploy serious capital on behalf of their clients or shareholders.
They need confidence, basically.
Exactly. Confidence in the legal status of the assets, confidence in secure custody solutions, clear compliance requirements, predictable tax implications. XBTO highlights that in 2025, crypto seems to have moved beyond being just a fringe, highly speculative bet for most institutions. It's becoming a core consideration in institutional portfolio construction discussions.
Are we seeing actual evidence of this increased interest translating into planned allocations, not just talk?
Yes, there's data suggesting it's more than just talk. XBTO cites sources, like a recent Coinbase survey of institutional investors, indicating that over 75% of those surveyed plan to increase their crypto allocations in 2025.
Wow, 3/4 plan to increase.
And significantly, among those planning to increase, 59% are looking to allocate over 5% of their total assets under management, AUM, into crypto.
Over 5%. That's not a token allocation anymore. That's a meaningful portfolio waiting for large institutions.
It represents a substantial commitment, moving beyond just testing the waters to incorporating crypto as a potentially strategic part of their overall asset mix.
So what kind of strategies are institutions using now that regulatory clarity is improving? It's probably more sophisticated than just buying Bitcoin and holding on for dear life, right?
Oh, much more sophisticated. The improving regulatory clarity, especially around custody and derivatives, enables institutions to implement more complex strategies that require robust, compliant infrastructure and risk management tools. XBTO outlines several approaches becoming more common. Diversification. They're building portfolios that go beyond just Bitcoin and Ethereum. They're balancing these core blue-chip assets with a broader mix of altcoins, perhaps targeting specific areas like promising Layer 1 or Layer 2 protocols, DeFi infrastructure plays, or other sector-specific themes. Stablecoins are also used very strategically within these portfolios as a cash equivalent for liquidity, for yield generation opportunities, for dynamic rebalancing between volatile assets, or as a defensive risk-off allocation during market downturns.
So building a real portfolio, not just holding one or two coins.
Exactly. XBTO even suggests a hypothetical breakdown, which of course needs adjusting based on risk tolerance. Might be something like 60-70% in core assets, BTC, 20-30% in a diversified basket of altcoins, and maybe 5-10% in stable coins for that strategic flexibility. Active risk management. Given crypto's inherent volatility, active risk management is absolutely crucial for institutions. They're increasingly turning to specialized active fund managers who can employ tactical positioning, conduct real-time rebalancing based on market conditions, and importantly, use regulated derivatives like futures and options to hedge downside exposure or express specific market views. These active managers look to exploit market volatility and inefficiencies through strategies like arbitrage between different exchanges, trading temporary price dislocations, rotating capital between sectors they believe will outperform, employing momentum strategies, or even taking contrarian positions.
So actively managing the risk, not just accepting the volatility.
Correct. And related to that is dynamic rebalancing. Static set-and-forget-it portfolios really struggle with crypto's wild price swings. So institutions are adopting dynamic rebalancing strategies. This might mean rebalancing back to target weights on a set schedule, like quarterly, or more dynamically, rebalancing when market movements cause allocations to drift significantly from their targets, or when volatility spikes above certain thresholds. Some are even exploring sophisticated volatility targeting strategies, where the allocation to riskier assets like altcoins is automatically scaled down during periods of extremely high market volatility, aiming to maintain a more consistent overall portfolio risk exposure over time. Institutional-grade risk analytics. They're not just guessing, they're applying the same rigorous risk management tools they use in traditional finance to their crypto allocations. This includes calculating value at risk, VAR, to estimate potential maximum losses under adverse market conditions over a specific time frame, performing detailed volatility analysis to inform position sizing and risk budgeting,
Constructing correlation matrices to understand how different crypto assets move in relation to each other and traditional assets to ensure diversification is truly effective, and conducting stress testing, basically simulating how the portfolio would perform during extreme hypothetical market shocks, like a certain 50% crash in Bitcoin, to understand potential vulnerabilities.
Okay, so they're really bringing their existing financial engineering toolkit and applying it seriously to this new asset class. What specific portfolio construction models are gaining traction among institutions, according to XBTO?
XBTO describes a few established frameworks that are being adapted effectively for crypto. The 60-30-10 core satellite model. This is similar in concept to the traditional 60-40 stock bond portfolio, but adapted for crypto's unique characteristics. It typically involves a large core allocation, say 60%, to the established, relatively lower volatility assets like Bitcoin and Ethereum. Then a satellite allocation, maybe 30%, dedicated to diversifiers and potential growth drivers. This could include large-cap altcoins, promising DeFi tokens, Layer 2 scaling solutions, or exposure to emerging themes like tokenized real-world assets, RWAs. And finally, a smaller allocation, perhaps 10% to stablecoins or possibly tokenized yield-bearing assets for liquidity, stability, and rebalancing potential. Satellite portion is often where active managers focus their efforts to generate alpha or outperformance. Thematic tilt portfolios. This is for managers or institutions with very high conviction in specific subsectors within the crypto ecosystem. This model involves intentionally over-indexing or tilting the portfolio significantly towards those areas.
For example, dedicating a large portion to DeFi protocols or focusing heavily on the infrastructure layer of Web3 and decentralized identity. This approach obviously requires deep fundamental research, strong conviction, and very active oversight. Risk parity-inspired allocation. This is a more quantitative approach. Instead of allocating capital based simply on dollar amounts, like 50% BTC, 50% ETH, risk parity models allocate capital based on the volatility and correlation contribution of each asset to the total portfolio risk. The goal is to achieve a more balanced risk exposure across different asset types so that no single asset dominates the portfolio's overall volatility. This is particularly relevant in crypto, where correlations can shift rapidly and volatility varies dramatically between assets. It requires sophisticated modeling tools.
Beyond these specific models, what other practical considerations are top of mind for institutions building crypto portfolios?
XBTO mentions several other crucial factors. One is the decision between using a dynamic allocation approach, one that actively adjusts weights based on market trends or momentum signals, versus a more fixed strategic allocation that's rebalanced periodically. That requires robust modeling and a clear investment philosophy. Another is benchmarking performance. Evaluating how well a crypto portfolio or fund manager is doing requires comparing performance against relevant crypto market indexes, perhaps a simple 50-50 BTC ETH index, or more complex benchmarks depending on the strategy. And critically, screening potential investments for sufficient liquidity is absolutely paramount for institutions.
Meaning they need to be able to buy and sell large amounts without moving the price too much.
Exactly. Institutions need to ensure they can enter and exit positions of significant size without causing massive price slippage, especially during volatile market conditions when everyone might be heading for the exits at once. So applying screens based on minimum average daily trading volume and assessing market depth on reputable exchanges is an essential part of the due diligence process for any asset they consider including.
It really sounds like institutional involvement has moved far beyond simply buying some crypto to actively managing digital assets within sophisticated, risk-controlled portfolio frameworks.
That is absolutely the key takeaway from XBTO's analysis. By 2025, for many forward-thinking institutions, digital assets are being viewed not just as speculative lottery tickets, but as strategic, manageable components of a diversified investment portfolio. XBTO emphasizes that capturing the potential upside in crypto requires more than just making an initial allocation. It demands structure, rigorous risk discipline, and increasingly professional active management.
And the market structure itself helps active managers.
Yes, XBTO points out that the unique market microstructure of crypto actually offers advantages for skilled active managers. The continuous 247 trading allows for immediate response to global events and helps manage volatility around the clock. The wide variety of trading venues, both centralized exchanges, CEXs, and decentralized exchanges, DEXs, provides opportunities for risk management, diversification, arbitrage, and accessing diverse pools of liquidity. The seamless integration of spot markets and derivatives markets allows for sophisticated hedging strategies, leverage, and other tactics like volatility selling, capturing funding rates, or basis trading. And frankly, the relative inefficiency of crypto markets compared to mature traditional markets still offers opportunities, things like geographical price differences. The kimchi premium was a famous example, or temporary mispricings between related assets that skilled managers can exploit to generate alpha.
So the combination of improving regulation and this unique market structure is making it a compelling area for active institutional management.
That's the conclusion. XBTO argues that with the emerging regulatory clarity providing guardrails, combined with appropriate governance structures, reliable institutional-grade partners like custodians and brokers, and robust internal processes, crypto is transitioning from being merely investable to becoming increasingly essential for institutions aiming to build resilient and forward-looking portfolios. Allocation is just the start. Effective management is seen as the true edge.
Okay, so the overall picture that emerges from looking across all these sources, from Fidelity, Alpha Point, Latham, Merkle, Gordon Law, XBTO, Paradigm, it really is one of significant momentum. Momentum towards a more defined, potentially more favorable regulatory environment in the U.S. And that, in turn, seems to be facilitating much greater institutional interest and sophistication in the market. It feels like a generally positive trajectory overall. But it can't be entirely smooth sailing, right? What are the remaining challenges or uncertainties as we look ahead?
That's a very important point. While the optimism is certainly higher than it has been in years, perhaps ever, it's crucial to acknowledge that implementing comprehensive regulatory policy proposals takes time, a lot of time usually. Both Fidelity and Alpha Point, citing Commissioner Hester Pierce herself, note that full implementation of major new frameworks is likely not imminent.
Right. Washington doesn't exactly move at the speed of crypto development.
Precisely. Even with strong political will, navigating the complexities of the legislative process, if new laws are needed, and the regulatory rulemaking process, for agency rules, is inherently complex and slow. There are comment periods, legal challenges, interagency coordination. So even if significant new laws or rules do materialize based on the current positive signals, they will likely unfold over a considerable period, not overnight.
Patience is still required. What else?
Another ongoing challenge is existing litigation. There are still high-profile court cases working their way through the system, like the long-running SEC v. Ripple case, which Alpha Point mentions specifically. The final outcomes of these cases could still set very important legal precedents that might redefine how certain assets are classified or clarify the boundaries of agency jurisdiction. These outcomes could significantly impact the development of future rules and create uncertainty in the meantime until they are resolved. Resolving these legacy cases could actually help clarify the path forward for new regulations.
And as we saw even within the SEC's recent clarifications, like the stablecoin guidance, it doesn't mean everyone within the commission or the government always agrees on the best path forward, does it?
That's absolutely true. Differing opinions exist not just within the agencies themselves, but certainly across the political spectrum, and even among different segments of the crypto industry. For example, Fidelity discusses the concept of a U.S. government crypto reserve. The idea, sometimes floated in proposed legislation like the hypothetical Bitcoin Act, or referenced in past executive orders, that the U.S. government itself might potentially hold Bitcoin or other crypto assets as part of its reserves.
That's a controversial idea.
Hugely controversial. There are significantly mixed opinions. Some proponents see it as the ultimate validation, legitimizing crypto as a strategic national asset, potentially boosting adoption. But critics argue it fundamentally contradicts the decentralized ethos of crypto, which aims to be an alternative to government-controlled currency. And then you have skeptics who simply question the wisdom and practicality of a government holding such inherently volatile assets as part of its official reserves. These kinds of ongoing debates highlight that consensus on fundamental crypto policy isn't universal, even among those who are generally supportive of innovation in the space.
Right. And Paradigm's push for a special committee for DeFi perpetuals shows there are still fundamental disagreements on how to regulate certain cutting-edge areas, too.
Exactly. There's still that tension between pushing for genuinely tech-neutral, purpose-built frameworks versus just trying to shoehorn new innovations into old regulatory boxes that may not fit.
So while the goal seems to be clarity, we're not completely there yet across the board, and there are still significant areas of debate, uncertainty, and just plain unresolved questions.
Precisely. Specific areas like the precise classification of all the diverse digital assets out there continue to be refined through ongoing agency actions, interpretive guidance, and potentially future proposals like building on the CFTC's DAMS framework concepts. Developing clear, workable, and secure frameworks for crypto custody, particularly for institutions and traditional financial firms wanting to offer services, is still very much a work in progress, although the SEC task force has clearly prioritized it. And the exact roles and potential future actions of other agencies, like whether the CFPB might try again on consumer protection, or how other bodies might interact with stablecoins or DeFi, remain areas that everyone is watching closely.
But despite these remaining hurdles and ongoing debates, the overall direction, based on the sources we've covered today, still seems decidedly positive, pointing towards a more mature, more integrated, and more clearly regulated market.
That really is the prevailing sentiment that comes through across the different sources, yes. The path forward appears focused on establishing a more transparent and predictable legal and regulatory environment, one that aims to support responsible innovation while ensuring robust investor protection, trying to strike that balance. Alpha Point concludes that this shift is poised to contribute significantly to the continued growth and maturation of digital assets within the U.S. financial system. And XBTO's analysis of institutional adoption strongly reinforces the idea that with the right governance, reliable partners, and clear processes all facilitated by clearer rules of the road, crypto can indeed move beyond niche speculation to become a valuable, perhaps even essential, part of the modern financial ecosystem.
We have taken a really deep dive today into a significant stack of sources, reports, legal analyses, regulatory trackers, tax guides, institutional perspectives, and the picture that emerges is, I think, undeniably one of fundamental transformation underway. The U.S. appears to be actively, tangibly moving towards a more defined and potentially significantly more favorable regulatory environment for crypto in 2025.
From those explicit, granular clarifications by the SEC staff, trying to draw lines around what isn't a security, to the landmark approvals of Bitcoin and Ether ETFs, bringing crypto access into mainstream investment accounts, to the banking regulators, systematically dismantling previous guidance that acted as major roadblocks for traditional finance. And of course, those very concrete, highly impactful changes coming to crypto tax reporting via the new Form 1099-DA. The landscape is shifting in really profound ways. And this isn't just theoretical talk or, hypothetical future scenarios. Based on the sources we've examined today, these are actions being taken right now or policies coming into effect very soon that directly impact how individuals like you and large institutions can interact with digital assets within the United States. It really does mark a clear departure from an era often characterized by uncertainty, ambiguity, and sometimes outright conflict towards a period focused on actually building out the rules of the road.
And this developing clarity, it isn't just about ticking regulatory compliance boxes, is it? It seems to be enabling confidence across the board. Confidence for major institutions to finally commit serious capital and bring their sophisticated strategies to this market. Confidence for builders and innovators to create new things within parameters they can actually understand. And crucial confidence for you, whether you're a seasoned crypto investor or just starting to explore this space, to navigate this market with a much better understanding of the rules, from trading decisions to custody choices to, yes, even handling those all-important taxes correctly.
The journey definitely isn't complete, and challenges and debates certainly remain, as we've discussed. But the stated goals of policymakers and regulators, combined with the observed actions documented in our sources, they indicate a clear and deliberate direction, a direction towards integrating digital assets more formally, more safely, and more predictably into the broader U.S. financial system.
So let's end with this. Here's a provocative thought for you to carry forward from our deep dive today and maybe mull over. With regulators actively working to define the boundaries more clearly, remove some of those old roadblocks, and potentially facilitate wider, safer participation. Does 2025 genuinely mark the year that crypto starts to shed its lingering Wild West image here in the US? Does it begin to solidify its place as a more mainstream, more understood, and yes, more regulated asset class? And if that is the case, if we are seeing that transition, how does that fundamental change in its perceived status from a risky frontier to something more integrated and mainstream, how does that alter the risks you face and the opportunities you should perhaps be evaluating in your own crypto journey? Something to definitely think about as you digest everything we've covered today.
Indeed. I think understanding this evolving regulatory framework, its nuances and implications, is rapidly becoming just as crucial as understanding the underlying technology or the day-to-day market trends for anyone wanting to successfully participate in this space going forward.